SBI has posted a strong show in FY22. The country's largest bank saw its net profit rise to 31,677 crores, a growth of 55% year-on-year, aided by a healthy loan growth, controlled operating margins, and a sharp fall in provisions. Robust asset quality and low credit cost underline the bank's earnings in FY22. The asset quality cycle that turned favorable for SBI over the past couple of years showed further improvement in FY22. Slippage ratio, which moderated in the past couple of years, fell to a record low of 1% in FY22 and stood much lower at 0.5% in Q4 FY22. Thanks to low slippages, credit cost almost halved in FY22. Despite that, provision coverage ratio improved to 75% in FY22 from 71% in FY21. SBI's asset quality is likely to remain upbeat as legacy corporate stressed accounts are fully identified and well provided for, which includes some of the names that have resurfaced recently like Future Group, SR Group, Shrey, etc. Its restructured loans stood at 30,629 crores, a mere 1.1% of the loan book as of March. SBI continues to surprise on retail growth. There's also a pickup in corporate credit due to better utilization of limits. While high inflation is likely to delay the revival of the private capex cycle, it will support the corporate credit demand in the near term. Rising interest rates will help the bank support margins in near term. The loan book will get repriced quickly as 74% of the loan book is floating with yields linked to some external benchmark. Deposits will get repriced with a lag effect. Overall, the top line is likely to remain healthy, which along with the buoyant asset quality will drive earnings in FY23. Overall, advances grew by 11% YOY as of March, led by retail loans which increased by 15% YOY. Home loan grew by 11% YOY and express credit by 29% year-on-year. Corporate book rose 6% YOY. The bank saw a healthy 10% growth in deposits. CASA ratio dipped slightly to 45% at the end of March 22 from 46% as of March 21. NIMs on domestic book improved by 10 bips during the year. Its domestic margins at 3.4% remain much lower compared to ICICI Bank and HDFC that are generating margins of 4% on domestic book. Operating expenses growth was contained. Cost-to-income ratio could fall further on the bank's digital initiatives. Asset quality trended better, and thanks to strong internal accruals, SBI remains adequately capitalized. SBI has disbursed 6,400 crores worth pre-approved personal loans through YONO in Q4. It opened around 26,000 savings accounts on a daily basis in Q4 through YONO. Around 63% of the savings account opened in FY22 were through the YONO platform, and it achieved mutual fund sales worth 10,000 crores in FY22 through YONO. At the current market price, the stock is trading at 0.7 times of the core book value estimated for FY24 and is attractive considering that the ROE has touched 14% in FY22. With asset quality looking relatively upbeat, we expect earnings to accelerate. The stock upside will also be driven by the expansion of valuation multiple. Given its sheer size and the leading market share, improved return ratios, and the end of bad asset quality cycle, SBI should command higher than its long-term historical average valuation multiple, which would be around 1.2 to 1.3 times forward book. The improving performance of the bank subsidiaries should boost sentiment. The near-term trigger for the stock could be the IPO of SBI AMC and/or an equity capital issue. In the long term, revival in private capex cycle will be a catalyst, and not to forget the blue sky scenario wherein the street starts noticing the progress made by YONO and assigns some value to it. SBI's distressed valuation is pricing in most risks ranging from government ownership to weakening macros. The stock is so undervalued that even the smallest of positive news can lead to re-rating.